Palantir investors just received a wave of extremely bullish developments from Wall Street, and the implications are far bigger than many people realize. While a portion of investors continues to shy away from Palantir because of concerns around valuation, that hesitation may ultimately prove to be a costly strategic error. The market has a long history of punishing those who focus too narrowly on price multiples while ignoring transformational business momentum, and Palantir may be a textbook example of that dynamic playing out in real time. To fully appreciate what is happening, it is important to understand the unique journey Palantir has taken over the past several years. The stock has delivered extraordinary long-term gains, but those returns have come with intense volatility along the way. Over the past 3 years, Palantir shares have climbed approximately 2,190%. That kind of performance alone places the company in rare territory. However, this rise has not followed a smooth upward path. During that same period, the stock has experienced declines of at least 20% on 10 different occasions, repeatedly testing investor conviction. The most dramatic example of this volatility occurred between early 2021 and early 2023, when Palantir lost more than 80% of its market value. That collapse was emotionally brutal for shareholders, and serves as a reminder that Palantir is not designed for investors seeking a calm or predictable ride. Instead, it rewards those who can endure extreme drawdowns while keeping their focus on long-term fundamentals rather than short-term price movements. Despite that history, valuation remains the most common criticism leveled against the stock today. By conventional standards, Palantir appears expensive. The shares currently trade at roughly 388 times earnings and about 116 times next year's expected earnings. On the surface, those numbers seem almost impossible to justify. Traditional valuation frameworks would suggest that expectations are already stretched beyond reason. Yet markets are not driven solely by tradition, and one well-respected Wall Street analyst believes Palantir has fundamentally altered the valuation conversation. Citi analyst Tyler Radke recently made headlines by maintaining a buy rating on Palantir while raising his price target to $235 per share. Relative to Tuesday's closing price, that target implies potential upside of over 42%. Such a forecast is striking given the already elevated valuation, and it signals strong confidence in the company's trajectory rather than blind optimism. Radke argues that Palantir has effectively broken established valuation models, including the Rule of 40, a commonly referenced benchmark used to assess the balance between growth and profitability in software companies. According to his assessment, Palantir's explosive acceleration in revenue growth, combined with expanding profit margins, places it outside the constraints of traditional metrics. In his view, the company is being undervalued by investors who fail to account for the scale and durability of its momentum. A central driver of this momentum is Palantir's artificial intelligence platform, which has seen rapid adoption across enterprise customers. Businesses are increasingly turning to the platform to integrate artificial intelligence into mission-critical operations, and that demand is translating directly into revenue acceleration. As more enterprises commit to Palantir's ecosystem, switching costs rise and long-term customer relationships deepen, strengthening the overall business model. Beyond the commercial opportunity, Radke also highlights powerful tailwinds in the government segment. Accelerating defense budgets and an urgent push toward modernization are creating favorable conditions for Palantir's software offerings. Governments are under pressure to modernize data infrastructure, enhance decision-making, and integrate artificial intelligence capabilities at scale. Palantir sits at the intersection of those priorities, positioning the company to benefit from what Radke describes as a ramping defense supercycle. Under this scenario, the government segment could deliver approximately 51% growth, while total company revenue could expand by between 70% and 80% in 2026. Those figures suggest a business that is still in the early stages of its growth curve, rather than one approaching maturity. Recent financial results lend credibility to this bullish outlook. In the third quarter, Palantir reported revenue growth of 63% year over year. While impressive on its own, that figure only hints at the broader story unfolding beneath the surface. The United States commercial segment, which includes the artificial intelligence platform, delivered truly exceptional performance. Revenue in this segment surged 121% year over year and grew 29% sequentially. As a result, United States commercial revenue now represents 34% of Palantir's total revenue base. This shift is significant because it demonstrates that Palantir is no longer dependent solely on government contracts. The commercial business is rapidly becoming a major growth engine, diversifying revenue streams claims and expanding the company's addressable market. Perhaps even more telling is the fact that the artificial intelligence platform has become so effective that government agencies themselves have begun adopting it, further reinforcing its credibility and versatility. Another critical indicator of Palantir's future growth lies in its remaining performance obligation. This metric represents contractually committed revenue that has not yet been recognized. Palantir's remaining performance obligation increased 65% to $2.6 billion, signaling strong demand and long-term visibility. This backlog provides a solid foundation for sustained revenue expansion in the years ahead. Management's confidence is reflected in updated guidance. The company raised its outlook and now expects full-year revenue to grow 53% to approximately $4.4 billion. Additionally, management forecasts that United States commercial revenue will rise by at least 104% to roughly $1.43 billion. These figures suggest that momentum is not slowing, but instead accelerating. All of this reinforces a key reality for investors. Palantir is not a stock for the faint of heart. Price swings can be violent, sentiment can shift rapidly, and patience is often tested. However, for investors with a long-term mindset and a tolerance for volatility, the combination of artificial intelligence adoption, enterprise demand, and defense modernization presents a powerful set of catalysts that could continue driving the stock higher. For those intrigued by Palantir's potential but uneasy about valuation, a measured approach may offer a sensible compromise. Initiating a small position allows participation without excessive risk, while gradually building exposure over time can reduce the impact of short-term price fluctuations. Dollar cost averaging in particular can be an effective strategy, enabling investors to acquire fewer shares when prices are elevated and more shares during periods of weakness. In the end, Palantir represents a rare blend of transformative technology, accelerating growth, and structural tailwinds. While the valuation debate will continue, the underlying business momentum suggests that dismissing the stock outright may be far more dangerous than enduring its volatility. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.